Welcome back to the Deep Dive. Today, we are tearing into the Q4 2025 earnings for JB Hunt Transport Services. That's JBHT.
Yep, and we're not just here to read you the numbers. We're trying to get at the sort of the tension behind them.
Exactly. It's this classic story, right? You have amazing operational execution meeting, well, a pretty disappointed investor base.
It really is. I mean, JB Hunt delivered a clean beat on the bottom line. Their internal execution was, almost flawless, and yet the stock dropped after hours.
So our mission today is to unpack that, to really dig into why.
And we need to figure out what management is really saying when they keep describing the freight market as fragile. Is that fragility a threat, or is it just maybe a massive opportunity waiting to happen?
Let's start right at the top with those headline results.
Yeah.
This is where that conflict starts. They reported after the bell yesterday, January 15th.
And on profit, they absolutely delivered. JAP EPS, it came in at $1.90.
$1.90. The street was expecting, what, $1.81?
Yeah, so a really significant beat there, up 24% year over year. I mean, they managed their own P&L beautifully.
Okay, but now here's the rub. Here's the thing that gave the market pause. Revenue.
Right. So revenue came in at $3.10 billion. That was a slight miss against the FactSet estimate of $3.12 billion.
A slight miss, but more importantly, it was a 2% decline compared to last year.
And that's the whole story right there. That small top-line shrinkage, plus the fact that the stock had run up, almost 50% in the 3 months before the call.
Expectations were through the roof.
Incredibly high, yeah. Investors weren't just looking for them to hold the line. They wanted to see an inflection. They wanted pricing, they wanted volume, and that revenue number just it didn't show it.
Now, operating income was up 19% year over year. It was at $246.5 million. That's a huge number.
It is, but you have to add some context. Management was pretty quick to point out that they were comparing against an easier number from the prior year, which had a $16 million pre-tax charge in it.
Okay, so that helps explain some of the big jumps.
It does. I mean, even if you smooth that out, the growth is still solid, but the story doesn't change. The profit beat was all about aggressive cost discipline and internal efficiency.
Not from a strong market.
Not at all. And for a company like this, that just signals that, the tough freight cycle is still very much in effect. The pressure's all on pricing.
So they're basically controlling what they can control while they wait for the market to turn. Let's get into that, because management really hammered this theme of strong execution and operational excellence.
They did. And they said they were setting a, quote, new internal benchmark for success. This wasn't just about tweaking things.
And the main engine for that was something they called the Lowering Our Cost to Serve initiative.
Yeah, and this is structural change, not just trimming a little fat here and there. They actually put numbers on it. They said they executed $25 million in tracked cost savings in Q4 alone.
Wait, $25 million in just one quarter?
In one quarter.
So that puts them on an annualized run rate of over $100 million.
$100 million. It's a massive operational lever.
Yeah.
And it was absolutely essential.
Why essential?
Because they explicitly said they're still fighting inflationary pressures. Insurance premiums going up, wages for drivers.
All their input costs are rising.
Right. In a market where they can't necessarily pass that on through pricing. So without those structural cost cuts, that EPS beat, it just wouldn't have happened.
It also seems like they're betting on themselves for the long term. I mean, their capital deployment, this speaks volumes.
Oh, absolutely. You see that discipline. They spent a company record $923 million on share buybacks in 2025. They retired 6.3 million shares. I mean, that's management saying, we think our stock is cheap. We think the market undervalues our future.
And at the same time, they're spending to grow. The tech, the Walmart intermodal assets.
Exactly. They're positioning themselves to absolutely dominate when the volume finally comes back.
Okay, let's drill down into the segments, because the story gets a lot more nuanced here. The success wasn't uniform across the board.
No, it wasn't. You can really see where the pressure is versus where that operational excellence is paying off.
Let's start with the big one, the earnings engine. Intermodal or JBI?
Yeah. So operating income there was up an impressive 16%. 16% on revenue that was down 3%. So less money coming in the door, but higher profit. How'd they do that?
It was all about efficiency. I mean, their overall volume was down 2%. Transcontinental loads got hit hard, down 6%.
But their eastern loads were up 5%, which helped. It helped, but the real magic was in network balance and drayage efficiency. And just for our listeners, drayage is basically just moving the container from the rail yard to the customer's door and back.
So being more efficient there means fewer empty miles. Trucks are always moving stuff that makes money.
Precisely. And the fact that they could grow operating income by that much while volume was shrinking, it just proves those cost initiatives are working right at the core of the business.
Okay. Moving on to the sort of the steady eddy of the business.
Yeah.
Dedicated contract services, or DCS.
Right. This is the predictable part. Revenue up 1%, operating income up 9%. And customer retention still super high at around 94%. It's an incredibly stable segment.
But the outlook there felt a little cautious, maybe?
It was. They said to expect only modest operating income growth in 2026. And the reason is that the sales cycle is getting longer.
So new contracts are just taking longer to sign because of all the macro uncertainty.
That's it. And management pointed out that it takes about 6 months for a new contract to really start contributing to profit because of, the startup lag. So new wins today won't really hit the bottom line until the back half of 26.
Now let's talk about the segment that gave us the clearest signal about the external market pressure. That's Integrated Capacity Solutions, ICS, which is their brokerage business.
This is a huge signal for the whole freight market. I mean, on one hand, they did a great job controlling costs. They narrowed their operating loss to just $3.3 million.
Down from what, almost $22 million a year ago?
Yeah, a painful $21.8 million. So that's great progress. But the margins tell the real story.
Gross margin compressed sharply. It fell from 17.3% all the way down to 12.4%. That's a huge drop.
It is. And what that tells you is that capacity out there got really tight, especially late in the year, November, December.
Because brokerage has to go out and find trucks on the spot market.
Right. And when capacity gets tight, the rates they have to pay for those trucks shoot up. That margin compression means they had to pay a lot more for transportation, and they couldn't pass all of that cost on to their customers.
So that's the first real evidence that the supply of trucks in the market is thinning out.
The most tangible evidence we've seen.
Yep. And that kind of sets up the next piece. Truckload, or JBT, they saw a massive surge in volume.
Huge. Load volume was up 15%. Their 360-box volume up 11%. The volume was there. But again, pricing was the weakness.
Revenue per load, excluding fuel, was down 4%.
Exactly. So what this tells us is they are aggressively going after market share. They're sacrificing pricing to keep their trucks full.
Buying volume.
They're buying volume. It's a strategic choice, but it's another thing that weighs on that top-line revenue number.
And finally, the real soft spot, final mile.
Yeah.
Revenue down 10%, operating income just collapsed, down 43%.
Yeah, the demand weakness there was really clear. It's driven by soft consumer spending in areas like, furniture, appliances, that sort of thing.
And they flagged a pretty specific headwind for next year, too, right?
They did. They're expecting about a $90 million revenue headwind in 2026 because they're losing some legacy appliance business. So that's a hole they know they have to fill.
Okay. So when you put it all together, it's a picture of internal mastery.
Right. The JBI efficiency, the cost savings.
Masking this external market weakness that you see in the ICS margins and the JBT pricing.
And that really explains the tepid stock reaction. Investors looked right past the execution and focused only on that external weakness.
Which brings us to the core of their commentary. Management used that word, fragile, over and over to describe the market.
Yeah, and most people hear fragile and they think bad. But management was framing it as a potential positive fragility.
Okay, let's unpack that. Positive fragility, what's driving that?
It's two things. Regulatory enforcement is pushing some carriers out, and just the sustained economic pressure is forcing smaller operators to close up shop. And that leads to what they call low elasticity in supply.
Low elasticity in supply. Break that down for us.
So think of it like this. When supply is elastic, if demand ticks up, a flood of trucks immediately enters the market to chase the higher rates, which then pushes rates back down.
Right.
But when supply is inelastic, that capacity is gone for good. The trucks have been sold, the drivers found other jobs. So when demand goes up, capacity can't respond quickly.
And that lack of a quick response
is what creates explosive pricing power.
So JB Hunt is saying the tipping point is getting close because the supply side is so brittle.
Exactly. And they said their experience after Thanksgiving proved it. Even small upticks in demand created these huge ripples in the market, which confirmed for them that, capacity is really, really thin out there.
So they're getting ready to capture that demand when it finally shows up.
They are. And their bidding strategy reflects that. They're still going after backhaul volume aggressively to balance the network, but they're only being, cautiously optimistic on pushing for price increases in their main markets. They're not ready to call a full turnaround just yet.
Let's look at the math for Intermodal, because that's really the profit engine going forward. They said to get back to their target margin range of 10 to 12%, they need 3 points of improvement.
3 points. 1 point they're confident they have. That's the cost savings from the big initiative. They have good visibility there.
But the other 2 points?
The other 2 have to come from sustained volume and, crucially, from price recovery. And those 2 things depend entirely on that fragile external market.
And this is where the macro tailwinds might come in. They said their customers are getting more optimistic about the consumer, and they're expecting healthy tailwinds from tax refund season.
And that's not a small amount of money. We are talking an estimated $100 to $160 billion in refunds landing between March and May.
So if that hits the economy like people expect,
it could be the exact sort of small non-seasonal spark you need to really test that supply fragility we've been talking about.
A small trigger that causes a huge pricing reaction. That makes a lot of sense. They did all the internal work. Now they're just waiting for a little gasoline on the fire.
They're coiled and ready to spring.
Which brings us to our final segment. And as always, just a reminder, we are analyzing public information. This is purely for discussion and entertainment.
This is not financial advice.
But based on this whole fragile capacity story, what's the outrageous but plausible trade?
Look, the market punished JBHT for being cautious and for a tiny revenue miss. But management's comments, to me, are a massive signal. The downside of tight capacity, which we saw in those ICS margins, has an explosive upside when demand finally hits. We know their cost structure is fixed. We know some capacity has permanently left the market.
So you want to leverage that fixed cost base against a sudden surge in demand?
Precisely. The trade is a high-risk volatility play. You're betting on a capacity crunch in the second quarter. So buy out-of-the-money call options expiring in Q2, let's say June 2026.
And the thesis is that you get this perfect storm, inventories are lean, you had that $100 billion plus tax refund tailwind hitting in the spring.
And that documented lack of truckload elasticity causes a sudden, sharp, and totally non-seasonal pricing snapback.
Which would flow straight through their fixed cost base to the bottom line, creating massive operating leverage and sending their Q2 earnings soaring past what anyone expects right now.
It's a pure volatility bet. A bet that the supply chain flips from being just tight to being completely broken for a short period. Like it perfectly leverages their core message. Capacity is gone, and they're ready to monetize the slightest turn.
It's a fascinating trade idea. I think the core takeaway today is really clear. J.B. Hunt delivered this incredible operational success story.
Absolutely.
That just got completely obscured by the market's high valuation and its obsession with that small revenue miss. They've done the work.
They are playing offense. They said they aren't dependent on the market, just waiting for it. So since the cost side is fixed and the only things left are volume and price, here's the final thought for you to chew on.
Okay.
If that supply chain is truly as fragile as they say, how much of a demand shock is actually needed? Is it a tiny blip, or does it have to be a full-blown recovery to unlock that final explosive layer of profit?
That is the question 2026 is going to answer. As always, we appreciate you tuning in. Use this as a starting point for your own research.
We'll catch you on the next deep dive.